Welcome to the Strategy Sync YouTube channel. Please subscribe and like to hear new book summaries. We are diving deep today, straight into the heart of, well, the American economic evolution.
That's right.
We're going to be examining why, despite reports of record corporate profits and, low unemployment, so many Americans feel profoundly insecure about their future.
Indeed. And for this, we're embarking on a crucial exploration based on a really relevant book, Capital Evolution, The New American Economy, by Seth Levine and Elizabeth MacBride.
And this book doesn't just critique the system, right? It actually offers a vision for the future.
It does. It offers a detailed one.
So what exactly is the mission of this deep dive for you, the listener?
Well, the book asserts something pretty fundamental, with huge implications for every business leader, for every citizen, really. It says the rules governing business have changed.
Irrevocably, even.
Perhaps irrevocably. And that the neoliberal era, the one dominated by this single-minded pursuit of profit and efficiency, is, well, it's demonstrably coming to an end.
Okay, so our mission here is to unpack that argument.
Exactly. We're going to unpack their argument that a new economic system, which they call dynamic capitalism, is already emerging.
Yeah.
And it's not through revolution, but evolution.
So we'll look at the evidence?
We'll look at the widespread economic pain felt across America. We'll trace the history, the dominance of Milton Friedman's ideology.
And the power corporations now wield, which is, it's extraordinary.
Sometimes exceeding that of governments.
Yeah.
And crucially, we'll detail the practical, scalable solutions the book proposes to rebuild and protect what they see as the indispensable American middle class.
That sets a hefty agenda. Okay, let's unpack this heavy topic, and I think we have to start with the diagnosis. Levine and MacBride didn't write this book out of some abstract academic interest. They wrote it because they noticed something was happening. Business was becoming dangerously intertwined with America's fractious politics.
That's the critical starting observation.
Yeah.
They noticed that decisions that used to be just routine business operations like where to open a new factory or who to hire.
Simple stuff.
Right. Suddenly, all of that became subject to the highly weaponized language of politics.
So you get phrases like white rage or greedflation thrown around.
Exactly. And even terrifying threats of violence against CEOs and their families over corporate stances on social issues. Their motivation really came from realizing that corporate actions weren't just seen as economic anymore.
No, they were being scrutinized through this intensely polarized cultural and political lens.
Yeah, they saw that American society was fundamentally unstable and that instability was reflecting directly onto the private sector.
So what are the symptoms of this underlying crisis? The pain points they identify, they go way beyond just bad corporate balance sheets or lagging GDP, right? They point to a really deep failure at the human level.
Absolutely. And when you look at the evidence they present, it suggests our current system is failing at a foundational level that is, frankly, unique among developed nations.
The most stark measure being life expectancy.
The most stark, most tragic measure they cite is the falling average U.S. life expectancy. And this decline isn't driven by war or some natural disaster. It's driven by what economists Angus Deaton and Ann Case called deaths of despair.
Which are?
Shockingly high rates of mortality from opioids, alcohol, and suicide. And this is particularly concentrated among working-class individuals who have seen their economic opportunities just vanish.
This isn't just an individual failing. It's a visible systemic collapse.
It is, and it's one that peer-developed economies are largely avoiding.
And this idea of economic opportunity, the core promise of the American dream that hard work means upward mobility, that's disappearing, especially for the most vulnerable and really for the youngest generation.
Precisely. The book meticulously details how systemic racism continues to place these steep, often invisible economic obstacles in the path of Black Americans. It leads to generational wealth gaps that have barely closed.
And then you have the supposed inheritors of capitalism, the millennials.
Yeah, they're facing what feels like an existential financial crisis.
Huh.
They're struggling with crippling college debt, an anchor that, previous generations just didn't carry to the same extent.
Yeah.
And finding that core middle-class goal of homeownership.
It's virtually impossible.
It's virtually impossible because of exploding housing costs. And this pervasive financial precarity is leading to a profound dissatisfaction with the core ideas of capitalism itself.
And It's easy to just dismiss these as abstract national statistics, but the authors do a great job of bringing in these very human, specific accounts that make the data feel viscerally real.
Oh, absolutely.
They share the story of Elizabeth MacBride's sister, a high school teacher in what you'd think is a stable suburban district.
That firsthand account is so powerful because it just shatters the illusion that this economic strain is confined to, inner city poverty. The principal in this suburban district had to develop a form letter,
A form letter?
a standardized bureaucratic communication, just to notify teachers about newly homeless high school students.
Wow.
I mean, imagine the depth of economic strain in a community when families are losing their houses at a rate that requires a standardized, impersonal form for educators.
And this is happening in supposedly affluent suburban districts.
Exactly. But we often don't see it or talk about it because, as the authors note, we tend to live in these insular bubbles. We consume media that only confirms our existing worldview. And the disappearance of local newspapers, which used to document this kind of pain, that just obscures the true picture even more.
And this is where we get to the numbers driving this populist frustration. The inequality engine, it's been running at full tilt since the late 70s.
The comparison between executive and worker pay isn't just stark, it's an insult to the idea of shared growth. From 1978 to 2018, CEO compensation soared by over 900%.
Over 900%.
And in contrast, worker compensation over those same 4 decades crawled up just 11.9%.
That massive, almost incomprehensible divergence. It's not just a statistic. You can see its impact in the physical decay of the nation.
You really can.
Yeah.
When a community's wealth is concentrated at the very top, it affects local tax bases, infrastructure funding, all of it.
Yeah, in what used to be derisively called flyover country, you see factories slowly disintegrating and once stable middle-class neighborhoods just decaying.
And that combination of stagnation for the many and this hyper-visible wealth for the few, that's what creates what the authors call American exhaustion.
And we have to emphasize this exhaustion is inherently political. The book makes a direct link.
It does. The failure of the establishment, both business and political, to seriously address, understand, or even worse, to dismiss this widely felt pain, that's the crucial fuel for populist movements.
The book explicitly links this decades-long failure to the broad coalition that supported Donald Trump's political rise and his 2024 re-election bid.
Yes, and dismissing the real economic suffering behind these movements only validates their core arguments that the system is rigged and the elite are fundamentally out of touch.
So the diagnosis is grim, driven by decades of systemic inequality. But the authors, surprisingly, they maintain a sense of optimism. They see this as an inflection point.
They do. Their optimism is grounded in 2 non-negotiable beliefs. First, America still absolutely needs capitalism.
It's the most nimble system.
They see it as the most nimble, effective, and efficient system we've ever devised for organizing human energy and funneling resources to good, innovative ideas. It's a powerful force for progress when it's properly aligned.
And the second point.
Second, and this is the moral, political, and practical imperative, the foundational American middle class must be rebuilt and protected. A functional, stable democracy is simply impossible without a large, economically secure, and upwardly mobile middle class.
So they're not advocating to tear the system down?
No, not at all. They're advocating to actively, urgently evolve it into something better.
That sets the stage perfectly for our next section, the reign of shareholder primacy. To understand what needs evolving into dynamic capitalism, we have to recognize that the very definition of capitalism, the rules of the game, it's not fixed.
That's a critical insight we often forget. For roughly 50 years, from the 1970s onward, we've just taken for granted the neoliberal definition. Unfettered free markets, limited government, and this singular, rigid focus on maximizing profits exclusively for the shareholders.
But the book argues that definition, the neoliberal era, is ending.
It's ending because it has become unsustainable. Capitalism has taken different forms throughout history. Sometimes it prioritized productivity or labor or capital. Now, a new priority is emerging, sustainability and societal impact.
And the public, really dramatic signal of this shift happened in 2019 with the Business Roundtable, the BRT.
Yes.
And we're not talking about some fringe group. This is America's collection of top CEOs, Jamie Dimon, Jeff Bezos, all of them. What did they announce?
Well, for 5 decades, the BRT's internal dogma was rigid and clear. The paramount duty of management and of boards of directors is to the corporation's stockholders. That was the legal, cultural, moral pillar of shareholder primacy.
And then in 2019?
In 2019, they released a fundamentally new statement signed by 181 CEOs. And this statement committed them to delivering value to all stakeholders, customers, employees, suppliers, communities, for the future success of their companies and, crucially, for the country.
It was a formal public recognition that the old model was broken.
Completely broken.
And the implication, as the book suggests, is profound. This shift effectively asserts businesses, not government, as the dominant force in American society.
Precisely. They're stepping into a vacuum created by decades of fractured, gridlocked, and often inefficient government. The new statement reflects a realization among savvy leaders like Dimon that focusing solely on maximizing short-term shareholder value is actually an outcome of doing everything else right.
Right. You have to serve customers, train employees, pay suppliers.
All of it. If you fail to invest in any of those areas, you inevitably fail your shareholders in the long run.
That's the theory. Now, to make this abstract ideological change concrete, the book gives us the compelling case study of Dan Schulman, the former CEO of PayPal.
Great example.
What shocking discovery did he make about the financial health of his own workforce, and why was he so surprised?
Schulman, who signed that new BRT statement, was preparing for a town hall in 2019, and he got a routine report on employee well-being. And he was genuinely stunned.
What did he find?
He found that many of his 23,000 employees, particularly those in customer service centers, were struggling immensely to make ends meet. The most visceral detail was of a customer service rep in Omaha who was selling his blood plasma twice a month just to afford basic necessities.
Selling blood plasma. And his initial assumption, which was the accepted corporate doctrine, was that because PayPal was competitive in the labor market, everyone should have been fine.
His thinking was completely shaped by that neoliberal belief that markets always self-correct and work perfectly. He benchmarked PayPal's pay at or above its competitors, and he concluded, we must be attracting the best talent, so everyone should be fine.
But his conclusion was a direct rejection of that.
His ultimate inescapable conclusion was a direct rejection of the Friedman doctrine. The markets had utterly failed in setting a humane and livable wage floor. He realized that benchmarking against peers was simply benchmarking against systemic failure.
So after rejecting that black and white market view, what did he and PayPal actually do?
With strong board approval, they moved aggressively. They didn't just issue bonuses, they implemented structural changes. They increased pay across the board, moved the pay cycle to weekly instead of bi-monthly to help with cash flow.
And the healthcare piece was huge.
The most impactful thing, yes. They dramatically boosted the company's contribution to healthcare costs. And that single move reduced those expenses for the lowest paid workers by a staggering 60%. It immediately translated to more disposable income and less anxiety.
And they went beyond just wage analysis, right? They developed this incredibly detailed internal metric they called the net disposable income, or NDI.
This metric is key to understanding this new approach.
Yeah.
The NDI measured how much money an employee had left over after paying all basic expenses: housing, food, taxes, commuting, childcare. It forced them to look past the nominal salary number and consider the localized cost of living.
And what did they find?
They set a target NDI of over 20%. The alarming discovery was that half of their employees had NDI scores around a perilous 4%. That explained everything: the stress, the debt, the need to sell plasma.
And Schulman forcefully argued there was no financial trade-off for the company. This wasn't charity.
Not at all. He viewed this as strengthening the core engine of the business. He argued that the only sustainable competitive advantage a modern company has is the skill set, dedication, and passion of its employees.
And the results backed him up.
After the changes, employee engagement skyrocketed, and costly employee churn went down dramatically. He said the old idea that profit and purpose are at odds with each other is ridiculous.
This brings us right back to the foundational ideology Schulman rejected, Milton Friedman. To understand the rigidity of the last 50 years, we have to spend some serious time on the Friedman doctrine.
Friedman's influence cannot be overstated. His seminal 1970 New York Times Magazine essay, "The Social Responsibility of Business is to Increase Its Profits," was the philosophical blueprint for the whole neoliberal era.
And his core argument was deceptively simple.
It was. A corporate executive is legally and morally an agent of the owners, the shareholders. Therefore, spending corporate money on environmental causes or community projects is essentially spending somebody else's money for your own purposes. He called it a form of taxation without representation.
We have to place that view in its proper historical context, though. What shaped this belief that economic and political freedom were so tightly linked?
It's essential to remember he was born in 1912. His entire adult life was shaped by the rise of totalitarian regimes, the two world wars, the Great Depression, the existential threat of Soviet collectivism.
Right.
In 1947, he was part of the foundational Mont Pelerin Society, meeting with intellectual giants like Friedrich Hayek. They explicitly linked economic freedom and private property to political freedom. For them, any deviation from pure profit-driven capitalism risked putting society back on the road to serfdom.
So their movement was a philosophical, almost militant response to state planning?
It was. But here's the critical nuance that was often lost by his later followers. Even in that powerful 1970 essay, Friedman acknowledged that actions that look like social responsibility, like donating to a local school, could in fact be shrewd, long-term, self-interested business decisions.
To attract better employees, for example.
Exactly. But as his doctrine was implemented, the rigid, short-term focus on quarterly profits almost universally trumped that necessary long-term, nuanced view.
And that nuance was certainly lost as his ideas moved from the intellectual sphere into institutional power. How did the neoliberal ideology get such a grip on corporate America?
The institutionalization was swift and strategic. A key catalyst was Lewis F. Powell Jr.'s confidential 1971 memo, which warned business leaders that the free enterprise system was under attack and needed to organize politically.
And that spurred the creation of the Business Roundtable.
It spurred the massive expansion of the U.S. Chamber of Commerce, and critically, the formation of the Business Roundtable in 1972, which gave big business unified lobbying power.
And shortly after, the academic framework came along to justify huge executive pay packages.
Yes, Michael Jensen and William Meckling's 1976 paper, Theory of the Firm, was pivotal. It provided the mathematical justification for the philosophy. They argued that companies could be distracted from profits by frivolities, like generous employee relations.
And they championed stock options.
They championed compensating executives almost entirely with rich stock options and grants. This directly aligned the executives' personal incentives strictly with short-term increases in the stock price. And that's the intellectual groundwork for that 900% rise in CEO pay we talked about.
Which brings us to Section 3 and the extremes of shareholder primacy, the point where the doctrine just ran completely off the rails.
And the ultimate personification of the Friedman doctrine taken to its absolute, unforgiving extreme is General Electric under Jack Welch from 1981 to 2001. Welch perfectly embodied that single-minded focus on maximizing quarterly returns.
He earned the infamous moniker Neutron Jack.
He earned it by ruthlessly, almost mechanically, cutting costs. He instituted a policy of firing the bottom 10% of the workforce annually, regardless of performance, just based on a ranking. Under his leadership, GE shed about 250,000 employees.
And for years, the market treated him like a genius.
They did. GE stock price rose an average of 25% a year, an unparalleled performance that set the benchmark for corporate America.
But if the Dan Schulman story showed the hidden human cost, the GE story showed the corporate cost, that this relentless pursuit of short-term earnings was just not sustainable.
It was catastrophic in the long term. The GE that Welch built was ultimately a house of cards, heavily reliant on its unregulated GE capital arm and using dubious, misleading, and ultimately illegal accounting practices to meet those quarterly numbers.
Right. They paid a huge SEC fine for fraudulent reporting.
$200 million. The short-term focus so thoroughly compromised their long-term sustainability that GE, once the most valuable company in the world, was removed from the Dow Jones Industrial Average in 2018. It just imploded.
It's fascinating how that ideological dogma can blind leaders. If that focus led to a collapse like GE's, how did leaders rationalize continuing that model for so long?
It's the sheer momentum of the institutionalized metrics. The entire financial ecosystem, analysts, compensation committees, boards, they were all focused only on stock price.
Yeah.
And Welch didn't just practice this. He institutionalized it globally.
At the BRT itself. He personally led the effort at the BRT in 1997 to explicitly change their statement to enforce the strictest shareholder primacy view possible. He made sure his short-term model became the corporate norm worldwide.
Which brings us to the inevitable reaction. The BRT's 2019 pivot towards stakeholder capitalism immediately became politicized, focusing on the controversy around ESG, environmental, social, and governance, and what critics called woke capitalism.
And Larry Fink, the CEO of BlackRock, the world's largest asset manager, became the primary lightning rod for this debate.
Right, in his letters to CEOs.
In his powerful 2018 and 2019 letters, he pushed hard for companies to adopt a greater purpose. He explicitly stated, climate risk is investment risk, and that long-term profits and social purpose are inextricably linked.
But this push for ESG met enormous political and financial resistance, particularly from conservative groups. We need to cover both sides of that impartially. Absolutely. The criticism from the political right was rooted directly in the Friedman Doctrine. Their argument was that ESG mandates force companies to adopt political or social agendas that have nothing to do with maximizing shareholder return.
So they saw it as a violation of that core profit motive.
Exactly. State attorneys general, mostly Republicans, pushed for massive boycotts and divestment from BlackRock funds, claiming Fink was using client money to further a left-wing agenda.
And this political targeting had real financial consequences for Fink and BlackRock.
The backlash was severe. By 2023, Fink publicly admitted he was embarrassed to have been part of the stakeholder conversation. He noted BlackRock lost an estimated $4 billion due to misinformation. He now actively avoids using the term ESG because he feels it's been so successfully politicized, weaponized.
And the book argues that this whole fight over woke capitalism is mostly political theater, and it obscures a much more fundamental conflict.
That is the core insight of the book here. The real conflict isn't political correctness. It's a deep structural clash between those who adhere to short-term, rigid financial interests, the markets know best rationale, and those who embrace the complex, long-term systemic thinking of dynamic capitalism.
The political environment just made it impossible to have a rational dialogue.
It did. It led to a profound stalemate.
And we saw the chaotic consequences of this firsthand in the high-profile conflict between Disney and Florida Governor Ron DeSantis.
Yes, the Disney-Florida dispute over the state's Don't Say Gay bill is a powerful cautionary tale. After initial neutrality, the Disney CEO Bob Chapek reversed course after intense employee protests and promised to fight the legislation.
And the political response from DeSantis was immediate and punitive.
Swift and calculated. The governor responded by ordering an investigation and ultimately passing a law to dissolve the Reedy Creek Improvement District, the special tax district that had given Disney autonomy since the 1960s.
He explicitly framed Disney as bowing to political correctness.
He did. He weaponized his political power to turn the company into a cultural wedge issue for his national political ambitions.
But what's so crucial here, and what the book really emphasizes, is that the lasting collateral damage wasn't just felt by the corporation.
That's the tragic consequence. While Disney became a political target, the lasting harm was disproportionately felt in the public school system. Laws restricting teachers' professional judgment on divisive issues proliferated across 17 states in the wake of that conflict.
So the people in the middle, the teachers and students, bore the cost.
They bore the profound cost of this highly politicized fight.
The book uses two businesses with diametrically opposed values, Patagonia and Hobby Lobby, to show that transparent, value-driven decision-making is possible regardless of politics.
They are perfect, extreme counterpoints. Patagonia, led by the environmental champion Yvon Chouinard, represents the progressive end. In 2022, the family transferred the entire multi-billion-dollar company into a trust dedicated to fighting climate change. They made the earth their only shareholder.
That is values over profit in its purest form.
It is. And on the opposite end, you have Hobby Lobby, which operates based on strict, conservative, biblical principles that often lead them to willingly sacrifice revenue.
Right, they close all their stores on Sundays.
Every Sunday. And most famously, they successfully sued the U.S. government in a landmark Supreme Court case to be exempt from providing contraceptive coverage under the ACA, arguing it violated their religious freedom.
So the essential takeaway from these two cases is that purpose, no matter the ideology, can successfully drive a business.
The takeaway is that transparent, deeply held values, whether it's progressive environmentalism or conservative religious conviction, can drive massive corporate actions, even when those actions explicitly sacrifice short-term profits. It proves that purpose and profit are not mutually exclusive when a company is grounded in its beliefs.
All right, shifting gears to Section 4. Let's look backward to find a historical model for broader prosperity. The book talks a lot about what the UN called the Golden Age of Capitalism from roughly 1945 to 1973.
This period is the vital historical countermodel to the neoliberal age. This was a time when economic growth gains were widely shared across all segments of society. Productivity increased a strong 3.3% annually, more than double the rate we've seen since 1973.
And during this time, the foundation of the modern American middle class was really solidified.
It was the 40-hour work week, Paid vacations, a rising minimum wage, and a broad social safety net established with Social Security and Medicare.
It seems like a fundamentally different societal contract than what we have now.
It was built on a delicate, powerful, and effective social partnership among government, business, and labor. And it was marked by incredibly high public trust.
What were the numbers on that?
In 1958, 73% of Americans had confidence in the federal government. In 1966, 67% had confidence in big business. That level of trust allowed for massive long-term public investments, like the interstate highway system.
And the famous symbol of this partnership between capital and labor was the Treaty of Detroit.
The 1950 agreement between the United Auto Workers and General Motors is a key historical reference point. It institutionalized mechanisms for shared growth, like cost-of-living adjustments and defined benefit pension plans.
It gave people a secure path to the middle class.
It did. For 2 generations of manufacturing workers, it provided a predictable path and softened partisan divisions because it institutionalized the idea that workers deserved to share in productivity gains.
And the tax structure of that time underscores that consensus.
Absolutely. The top marginal tax rates for high earners regularly topped 90% during this period. Now, that's not necessarily a policy prescription for today, but it demonstrates a profoundly different cultural alignment about the distribution of wealth and collective responsibility.
A consensus that seems unimaginable today.
Simply unimaginable.
And the book ties this history directly to energy, specifically the centrality of fossil fuels to the Golden Age.
The stability and prosperity of that era were underpinned by cheap, abundant oil. The U.S. remains the world's top oil consumer. And the fortunes created by early oil barons, the Rockefellers, Mellons, early Kochs, exerted profound influence.
But those early elites had a different model of corporate citizenship.
They did. The first generation, like the Rockefeller Foundation, established widely accepted norms of philanthropy and giving back that tied corporate responsibility to the nation's overall welfare.
This leads us to the story of Marion Folsom, who really exemplifies that kind of private sector leadership crossing into government policy.
Folsom's story is fantastic. He wasn't a politician. He was an innovative executive at Kodak in the 1920s. He tried to solve worker insecurity by creating a private unemployment fund, the Rochester Plan.
But it was a private sector solution, and it failed.
It was overwhelmed by the sheer scale of the Great Depression. But Folsom learned a crucial lesson. Social problems that affect the entire population require the scale and scope of government to address.
So he became the ultimate bridge builder, taking his business ideas into the highest levels of policy.
That's right. He advised FDR's administration during the New Deal and later served as President Eisenhower's cabinet secretary. He is widely remembered as the primary architect of the Social Security Act.
His story proves that business leaders can shape core social policies.
Exactly. It shows they can be driven by a pragmatic sense of purpose and civic responsibility.
When did this consensus and this golden age begin to erode, setting the stage for the Friedman Doctrine?
The erosion began in the 1970s. You had a cascade of factors: the oil crises, high inflation, the massive cost of the Vietnam War, and diminished public trust after Watergate.
And the leadership in the oil industry changed.
The consensus established by the Rockefeller-era leadership began to fade, replaced by a new, more aggressive group of independent, anti-government oilmen, notably the Pew and Clough families, who embraced staunch libertarianism. This transition in energy leadership paralleled the ideological shift directly toward neoliberalism.
Let's move to Section 5, where the authors address the core crisis today, the hollowing out of middle class. They describe it as being treated like a commons to be exploited.
That is their central severe diagnosis. They argue the middle class is being systemically depleted as an asset, exploited for short-term profit through wage suppression and reduced benefits, and the data confirms it.
The middle class share of income has plummeted.
It fell from 62% in 1970 to just 43% in 2022. Concurrently, wealth concentration accelerated dramatically, with the richest 1% controlling 1/3 of the country's assets by 2021.
And structurally, the remaining middle class is sustained not by rising wages, but by an immense corrosive reliance on debt.
Debt-fueled consumption is now the primary engine keeping the economy churning. Household debt grew at 4 times the rate of income between 1950 and 2008.
And the resulting instability is terrifying.
It's palpable. 56% of Americans cannot afford an unexpected $1,000 expense. Median household savings are only around $8,000. This proximity to the financial edge dramatically increases anxiety and political volatility.
The book also asks this critical sociological question: Why is this profound economic pain so often ignored or misdiagnosed? It suggests class itself has become a taboo topic.
Sam Ryman, a foundation director, explained this societal blind spot well. He said talking about class is almost a matter of shame, particularly for white men who feel enormous pressure to fit into upper-class professional cultures.
So people are fundamentally insular.
And the system fosters this illusion of pure meritocracy. If you fail, the implication is that it must be your fault, not a systemic failure of opportunity. This absolves those at the top from responsibility.
This links directly to Coleman Hughes's provocative argument about identity politics.
Hughes argued that while conversations about race and identity are critical, they have often become so weaponized that they systematically obscure the underlying universal problem of class inequality.
He said, class is almost always a better proxy for true disadvantage.
Exactly. By constantly focusing narrowly on race and identity, the systemic failure of economic mobility for all vulnerable populations gets tragically ignored.
So how does dynamic capitalism propose to fix this? The central solution centers on rethinking ownership, moving more people from being labored to being capital owners.
This is the revolutionary core of their proposal. Since the mid-1990s, corporate profits have grown significantly faster than wages. So the necessary path forward, according to the book, is aggressively broadening ownership, actively turning more workers into genuine capitalists.
And the book gives the powerful case study of Pete Stavros at the venture capital firm KKR, which seems to fly in the face of traditional private equity.
Stavros, the son of a union worker, started a radical experiment at KKR. They broadened equity compensation, traditionally reserved only for senior execs, to include all employees in their portfolio companies, down to the factory floor.
And the results weren't abstract stock movements. They were truly life-changing payouts for frontline workers.
They were stunning. When KKR sold CHI overhead doors in 2022, the average worker received a life-changing payout of $175,000. These are people who could now pay off debt, fund college, afford a down payment.
And Stavros sees this not as altruism, but as rational business practice.
Purely rational. When employees are owners, engagement skyrockets, accidents decrease, and the company gains the only sustainable competitive advantage there is. And yet currently, only 18% of U.S. employees have any ownership stake. The potential for growth is massive.
Beyond corporate initiatives, what are the 3 concrete policy ideas the book suggests to create millions more capitalists?
They focus on access and fairness.
First,
retirement savings for all. This requires all employers to offer defined contribution plans, but the key is setting enrollment as the default so employees have to actively opt out.
Overcoming inertia.
Yes. Combined with state or federal matching funds, it could significantly boost savings for lower-wage workers.
The second idea is genuinely transformative for addressing inequality from birth.
That's the baby bonds proposal. The idea is to establish a modest, tax-free investment account for every child born in the U.S., invested in low-cost treasury funds.
So every American becomes a member of the capital class from birth.
Exactly. The book suggests even a small initial deposit, growing at 7% annually, could be worth nearly $17,000 by age 18, a vital start for education or homeownership.
And the third focuses on restoring dynamism being stifled by bureaucracy.
It focuses on lowering barriers to work. This means easing the dense regulatory burden and the chaotic patchwork of licensing requirements across states for middle-class jobs, hairstylists, plumbers, nurses. Dynamic capitalism requires the free movement of skilled labor.
Okay, let's wrap up with Section 6. Corporate power, global blind spots, and the fragile foundation. It's hard to overstate the power companies now possess.
The authors state that corporations have arguably emerged as the most important institutions globally, effectively surpassing nation-states in their influence and economic reach.
The scale is immense.
It is. Tech giants have trillion-dollar market caps, and retailers like Walmart generate annual revenues exceeding the entire GDP of developed nations like Sweden or Switzerland.
And governments, often failing to keep up, are becoming dangerously dependent on these giants.
You see it everywhere, especially in AI. Governments are turning directly to corporate CEOs from OpenAI and Microsoft to help develop regulations for technologies they barely understand.
Which runs the risk of regulatory capture.
A huge risk, where incumbent players write the rules that benefit themselves and suppress competition.
We also have to address the global blind spots created by decades of unnuanced free trade policy, especially concerning rivals like China.
The Westinghouse example is a perfect, devastating illustration. In 2007, Westinghouse signed a $7 billion deal to build nuclear reactors in China. Simultaneously, a Chinese hacking group was scaling 700,000 pages of their proprietary design documents.
And 10 years later, Westinghouse was bankrupt.
Bankrupt, having ceded market leadership to the very Chinese firms that benefited from the state-sponsored espionage.
And the book argues the U.S. has been persistently slow to recognize the national security risks here.
Absolutely. The failure to consider the national security implications of widely adopted foreign technology like TikTok has led to a major geopolitical dilemma and jeopardized the mental health of American youth.
Dynamic capitalism also has to reckon with the deep entanglement of fossil fuels.
Climate action, the book argues, requires a pragmatic coalition that blends the speed of the market with necessary government guardrails. The focus should be on scalable, market-driven mechanisms.
Like 1% for the planet.
Exactly. That organization requires its 5,200 member businesses to dedicate 1% of annual sales to environmental causes. It's a form of private market regulation.
And the authors highlight the importance of incremental progress rather than demanding impossible perfection.
Yes. Kate Williams of 1% for the Planet noted that society gains more from thousands of companies making meaningful, incremental changes than by demanding 100% adherence to unrealistic goals, which just discourages participation.
So when a company like Occidental Petroleum commits to net zero, that's a signal.
A huge signal. A major oil and gas consortium focusing on carbon capture signals a necessary, pragmatic, market-driven shift away from the purely extractive past.
Our final point brings us back to the most critical foundation of all, one often taken for granted, the rule of law.
No form of capitalism, dynamic or otherwise, can survive without the two essential pillars that uphold free markets: the rule of law and reliable access to information.
And the rule of law is under strain.
It's under extreme strain in the U.S. The book warns of targeted, erratic policy, the use of government institutions to penalize political opponents, and overt threats to judicial independence. This political interference undermines the trust necessary for long-term commerce.
And there's a powerful contradiction in the actions of groups fighting fiercely against woke capitalism.
This contradiction exposes the political rather than economic nature of the fight. Groups like Leonard Leo's Teneo Network, which preach limited government and free markets, paradoxically ask the courts to intervene and dictate how investment managers should run their funds.
So it's a cultural fight, not an economic one.
That's what the book concludes. Attacking values-driven capitalism is ultimately an attack on individual liberty, restraining a business leader's freedom to make long-term decisions that are transparent to investors and consumers.
So what does this transformation, this capital evolution, look like in summary for you, the listener?
Dynamic capitalism is about restoring necessary balance. It is a fundamental shift away from the rigid, short-term, extraction-focused model of neoliberalism toward a longer-term mindset. It recognizes that purpose, employees, and community are inextricably linked to long-term profit.
It demands flexible thinking and new coalitions.
And most importantly, creating a foundational base of owners to broaden American prosperity.
It demands that we not only evolve corporate behavior, but also implement scalable, common-sense policy.
The focus must be on building more middle-class capitalists. That means universalizing easy retirement plans, establishing baby bonds to give every child a stake in the system, and supporting businesses that align profit with purpose.
The goal is to reclaim the dynamism that defines the American dream.
Exactly. To ensure that hard work leads to ownership and security, not just debt-fueled exhaustion.
And here's where we leave you to mull over this profound shift. The viability of the American free market system depends entirely on two things we often take for granted: the rule of law and reliable access to information. The book's final chapter warns that if these foundations continue to erode at a national level, no amount of corporate purpose or free market principles can save the system. So, a question for you. What small, tangible actions can you take this week to support the rule of law or reliable information flow? Maybe by seeking out credible, unbiased local news, or by volunteering to support civic education in your own community. Think locally, act foundationally.